Hello everyone. Today we are going to start one of the important but a bit complex and a difficult accounting standard, the title of which is IFRS 15, Revenue from Contract with Customers. In today's discussion, we will cover a brief overview of IFRS 15. We will talk about its objective, its use and its importance in the context of financial reporting. Imagine yourself as an investor or as a shareholder of a company, or let's say someone approaches you with some business opportunity or with a proposal to make you invest in the company's stock. Your primary concern as a prospective investor, as a prospective stakeholder, is to understand the benefit of your investment, the business profitability and the income you could potentially earn from that business. In the world of business, or when considering investment in shares, our benefits are paramount. That what will be the return on our investment. Every investor, either current or future, pay close attention to the company's financial performance and is very much concerned about the profitability of the company. This is where IFRS 15 comes into play, focusing on the most critical figure in your financial statement, that is revenue. In order to assess the profitability of any company, we usually look at its income statement or the statement of profit and loss. But the profit and loss for the period is not calculated as per any accounting standard. Instead, it is calculated as a balancing figure in the income statement. Revenue is the starting point of the income statement, and after reporting revenue, we deduct cost of goods sold to arrive at gross profit. From the gross profit figure, we account for other expenses and other income to determine the annual profit and loss. Thus, the profit figure in the income statement is ultimately derived from the company's revenue and expenses. The higher the revenue, the more efficiently company manages its expenses, the better the profit and the better financial performance is presented. That's why IFRS 15 is essential for investors. It ensures that the revenue generated from the business activities is appropriately accounted for in the financial statements. Now, accounting standard of IFRS 15 is not a very old accounting standard. It was established in 2014 and the implementation started in some subsequent years. Previously, there were more than one accounting standard for revenue recognition. Like we used to have IS 18 for revenue, we used to have IS 11 for construction contract, and there were some multiple IFRS and SICs for clarification on different revenue transition. In short, revenue requirements were kept at multiple places in different accounting standards, and even there were some conflicting requirements among those standards. So IASB, that is International Accounting Standard Board, realizes that the figure of revenue in income statement is such of an importance from the perspective of financial statement and from the perspective of investor as well. So to recognize this important figure, to recognize this important number, there should be a single accounting standard rather than having multiple accounting standards. And finally, in 2014, the accounting standard of IFRS 15 was launched. Right now, whatever revenue is to be recorded, we have a single accounting standard to record it, and that is IFRS 15, revenue from contract with customer. If we look at the objective of this standard, the objective of IFRS 15 is to establish the principle for reporting useful information to the users of the financial statements about the nature, about the amount, about the timing, and about the uncertainty of revenue, and also cash flow arising from the contract with the customer. And following IFRS 15, one of the key figure, that is revenue, will be accounted for and presented in the financial statement. Also, we need to pay a close attention to one more thing. This standard caters to revenue from contract with customer. Revenue means the income or assets of the company that comes from the business activities of the company. That is generated from the operating activities of the company. For example, if we have a manufacturing company, revenue means sales generated from the sale of manufactured goods by such manufacturing company. For example, if there is a trading company, revenue is sales generated from selling the inventory of such trading company. And similarly, if there is any service provider, then revenue is the fee from services offered by the service provider. So if a company sells its non-current asset, the gain or loss from the disposal of such non-current asset is not reported as revenue in the income statement. Rather, it is presented as other income or other expenses. Similarly, if a company is earning any dividend income against any investment, or a company is earning any interest income against some lending, such income would be accounted for as per different accounting standard, that is IFRS 9, financial instrument. Secondly, IFRS 15 caters revenue from contract that have been entered with the customer of a company. Practically speaking, a company or a business can do a lot of transaction, a lot of contract with other peoples who are stakeholder but not the customer. For example, a company might exchange goods with other companies in the same line of business to facilitate sales to the customer. This would have happened with you as well. Like you go to a shopkeeper and ask for some particular product that is not available with such shopkeeper, and he made you wait and arrange the same product from his neighbor shop to facilitate you. This type of exchange between two shopkeepers are not contract with customers and are not accounted for under IFRS 15. In IFRS 15, we specifically talk about the revenue that will arise from those contracts that have been agreed with and undertaken with the customers of a company. Now, let's discuss a brief overview of IFRS 15. IFRS 15 provides us with a principle-based 5-step model for revenue recognition. In today's lecture, we will discuss a brief overview of these 5 steps with the help of simple illustration. But we will cover each step in greater detail and do multiple illustrations on each steps in our coming lecture. So let's move towards the IFRS 15 principle-based 5-step model for revenue recognition. First of all, step 1 is to identify the contract with the customer. That means, first of all, you have to identify the contract with your customer. When it comes to a contract, most of the people think that there should be a written contract. But as per IFRS 15, contract means an enforceable agreement. We will definitely discuss in detail about the step 1. We will cover some criteria, conditions, modalities, prerequisites of the contract, but not now. We will cover these things at some later stage. For now, we have to understand that contract means an enforceable agreement, and it is not necessary that it must be a written contract. The format of the contract depends on the market in which we are operating, the location in which our business is running, and the local norms, the local regulations, and the local practices. So depending upon the norms and regulations of the market in which we are operating, the contract can be a written contract, it can be a verbal contract. Even the contract can be an express contract or it can be an implied contract. For example, practically when we purchase some land or building, we definitely do a written contract. But when we go to buy some grocery from the grocery store, there is no need of written contract there, and the contract is established verbally. So step 1 is to identify the contract with the customer, and we will cover a lot more details about this step in the upcoming lectures. But for the time being, contract means an enforceable agreement between the parties, and depending upon the norms, depending upon the regulations of the market in which we are operating, depending upon the rules and regulation of the jurisdiction in which we are conducting our business, the contract can be a written contract, it can be a verbal contract, it can be an express, or it can be an implied contract. Next is step 2, that is to identify the performance obligation in the contract. In the accounting standard of IFRS 15, performance obligation means goods and services. Generally, if we have a two-party contract, one party provides goods and services to the other party, that is customer, and the customer pay consideration to the first party. So in this contract, the party which is providing the goods and services to the customer, these goods and services are called performance obligation in IFRS 15. In step 2, we have to identify the performance obligation in the contract, like what goods and services are we going to give to our customer in the contract. In the details of step 2, IFRS 15 says that performance obligation is a promise in a contract to transfer to a customer goods and services that are distinct. But when we go into detailing of the step 2, we will cover about the term distinct. What does distinct mean? Basically, as per IFRS 15, every goods and service which fulfill the criteria of being distinct are distinct goods and service and would be considered as a separate performance obligation. Obviously, there is some criteria, there is some condition of being distinct, then every goods and service which fulfill those criteria of being distinct would be considered as a separate performance obligation. For the time being, you can understand the term distinct as different. What does distinct mean? It means different. Every different goods and service in a contract will be considered as a separate performance obligation in a contract. After this, we have step 3 to determine the transition price of the contract. As I told you earlier, that if we have a two-party contract, one party will be providing goods and services to the other party, that is customer, and the customer will be paying some consideration to the first party against those goods and services. Transition price is basically the consideration that the customer pay to the company for the provided goods and services, like how much money or cash the customer is going to pay for the goods and services received. After this, we have step 4, that is to allocate the transition price to each performance obligation on the basis of standalone selling price, that is market price of each performance obligation. In step 4, transition price will be allocated or apportioned to each performance obligation on the basis of standalone selling price, that is market price of each performance obligation. And then finally, we have the last step, that is step 5, to recognize revenue as and when each performance obligation is satisfied. Now, the satisfaction of performance obligation, that is providing goods and services to the customer, can be either at a point of time or it can be either over a period of time. Depending upon the scenario, depending upon the nature of goods and services, there will be some goods and services whose control will be transferred to a customer at a point of time. So it means performance obligation is satisfied at a point of time and we have to recognize revenue at a point of time. But on the other hand, there might be some goods or services, the nature of which are such that it will be provided to the customer over a period of time. its mean performance obligation will be satisfied over a period of time, and in this case revenue will be recognized over the period of time. So in IFRS 15 we have a principle based 5-step model to recognize revenue. Step 1 is to identify the contract with the customer. Step 2 is to identify the performance obligation, that is distinct goods and services in the contract. Step 3 is to determine the transition price. Step 4 is to allocate the transition price to each performance obligation based on standalone selling price of each performance obligation. And finally, step 5 to recognize revenue as each performance obligation is satisfied either at a point of time or either over a period of time. So this is the short overview of principle based 5-step model. In our next lectures, we will cover each step in greater detail. What are the modalities, what are the conditions, what are the prerequisites of each steps, and we will cover all these things in greater detail in coming time. But for the time being, we have discussed a brief overview of IFRS 15 principle based 5-step model. Now let's see a simple illustration on this. A simple illustration about the 5-step revenue recognition model as per IFRS 15. It says, on 1st December 2021, Wait Enterprises receives an order from a customer for computer as well as 12 months of technical support. Wait delivered the computer and transferred its legal title to the customer on the same day, and the customer paid $420 upfront for the contract. If sold individually, the selling price of the computer is $300 and the selling price of the technical support is $120. In the requirement, it requires us to apply the 5-stage model of IFRS 15 and to determine how much revenue Wait should recognize in the year ended 31st December 2021. So by applying the principle based 5-step model of IFRS 15, we have to determine how much revenue we have to recognize by 31st December 2021. In this simple scenario, we will apply the 5-step model of revenue recognition. Step 1 is to identify the contract with the customer. If you see the first line of the illustration, it clearly says that Wait Enterprises receives an order from the customer. So getting an order from the customer is a contract with the customer. So step 1 is completed, that is identify the contract with the customer. Step 2 is to identify the performance obligation, and as we know earlier that every distinct goods and services would be considered as a separate performance obligation. So we can see clearly from the contract that there are two performance obligations in this contract. Number 1 is computer and the number 2 is 12 months of technical support. After that, step 3 is to determine the transition price. So how much the customer will pay Wait Enterprises in this contract? It is $420. So $420 is the transition price. Step 4 is to allocate transition price to each performance obligation on the basis of standalone selling price of each performance obligation. Our contract has two performance obligations, computer and 12 months of technical support. And our contract transition price is $420. We have to allocate this $420 transition price in both of these performance obligations on the basis of their standalone selling price. So to calculate the allocated portion of transition price to computer, we have to multiply 420 by 300, that is computer's standalone selling price, and divide it by 300 plus 120, that is sum of computer and technical support standalone selling price, then we will get 300. Similarly, to calculate allocated portion of the transition price to technical support, transition price of 420 will be multiplied by 120, that is technical support standalone selling price, and divided by 300 plus 120, that is the sum of computer and technical support standalone selling price, then we will get 120. So we have allocated transition price of 420 between the computer and the technical support into 300 and $120. And finally, we have the last step, that is to recognize revenue as or when each performance obligation is satisfied. To understand how much performance obligation will be satisfied, we have to understand the nature of goods and services in the contract. As the contract says that the legal title of the computer will be transferred to the customer on day 1, that is 1st December 2021. Therefore, the allocated price, the allocated transition price of the computer, that is 300, revenue of 300 should be recorded on 1st December 2021. In this scenario, computer is such a performance obligation which is satisfied at a point of time, and since it is being satisfied at a point of time, its revenue will be recognized at a point of time, that is 1st December 2021. But on the other hand, technical support is such a performance obligation which we have to provide over the period of 12 months. Wait Enterprises have promised the customer to provide technical services for the next 12 months. This means revenue against technical support should be recognized over the period of time over the next 12 months. In order to record our revenue till year end 31st December 2021, on 1st December, Wait have satisfied the performance obligation of computer. Wait will record revenue of 300 on 1st December 2021. And after 1 month, when our year end of the company comes, that is 31st December 2021, then out of 12 months, we have provided 1 month of technical support. Therefore, 120 multiplied by 1 divided by 12, and we will be recognizing the revenue of $10 against the technical support. So ultimately, till year end 31st December 2021, we have recognized revenue of 310, that is $310. Rest of the revenue against technical services, against the technical support of the remaining 11 months will be recorded in the coming year, that is 2022. So till now in today's discussion, we have discussed a brief overview of 5-step model for revenue recognition under IFRS 15 with the help of a simple illustration. We have to cover each step in greater detail, and we will cover that in the upcoming lectures. I hope I have been able to explain all these things to you. Thank you.